Well, good afternoon, everyone. If I could invite you to take your seats, and we'll get started with our keynote luncheon discussion. I'm Merit Jano, Dean of the School of International and Public Affairs, and it's really an enormous pleasure to welcome you here today. As I've been walking around, people have been saying to me that this is a great discussion, really important, and I couldn't agree more. It does feel to me that the combination of globalization, technological change, and the aftermath of the financial crisis and the regulatory forms that it is and might take, as well as the societal responses to it across the world, are just crucial issues for us to engage in the world. And at SEPA, we have at SEPA a long tradition of just remarkable faculty who focus on international trade, economics, finance, from both emerging markets and developed economy perspectives. And in the last several years, we've thought it was indispensable that we deepen our expertise and commitment to focus on central banking financial regulatory issues. We're producing hundreds of students every year who are going into central banks, treasuries, financial institutions, and without a deep grounding in today's environment around financial regulatory and macroprudential and other issues, they're not sufficiently equipped, I think, to deal with the world as it's emerging. We also created a few years ago a new initiative around technology and data and public policy. My own feeling is that a certain degree of data analytics has become capacity. It's like economics. Everyone has to have it as a basic building block for young professionals. And these twin elements obviously merge in that our work around security now must also focus on cybersecurity, and those who are thinking and studying financial systems now also need to be working with and thinking about financial stability and cyber risk. So I think a global institution like ours, an institution that's committed to looking at issues that are trans-border as well as national in character, can bring these fields together, and that's wonderfully represented by those who are in this room today. So I thank you very much for joining us, and I want to congratulate Dr. Patricia Moser, who leads our central banking initiative, for putting this together. And again, thank Imperial College for your collaboration with us. For me, it's just been an absolute delight and a great joy to have Secretary Liu with us on our faculty. He joined us earlier this year, and introducing him is just underscores always the remarkable background that he brings to discussions such as his remarks today. As you know, he led the Treasury Department from 2013 to January 2017 as the 76th Secretary of the Treasury. And of course, when he took office, the U.S. economy was struggling after the worst financial crisis since the Great Depression. He led that agency and helped steer the economy to a much more healthy state with declining unemployment. And he also played a key role on numerous issues that you're thinking about today, whether it's around the debt ceiling renegotiations or the government's own organization and oversight of financial policy matters with the Financial Stability Oversight Council and many other responsibilities. Prior to that, he was the White House Chief of Staff and Director of the OMB. And as White House Chief of Staff, I can't imagine. As a dean, I feel I'm dealing from everything from student issues to financial issues to systemic issues, but as White House Chief of Staff, I just can't imagine from politics to public policy, one of the most challenging jobs in Washington. And before that, of course, he served in a very senior position at Citigroup, was Executive Vice President and Chief Operating Officer of another great university in New York City, NYU, and a professor of public administration. So I just think that he brings to this discussion an unequaled span of perspective on the U.S. and the global economy, as well as the political economy and the management of issues. So please join me in welcoming him to this discussion. Afterwards, we'll have a chance for Q&A and hear your thoughts. Thank you.
Thank you so much, Dean Jano, for that very kind and generous introduction, and for providing me with such a hospitable place to make my transition back into private life. And thank you, Trish, for organizing this gathering, which is very timely, and it's on an important topic that I think all of us are going to be spending more time on in the years ahead. We gather at a time when technology promises to change the economy of the future, and it raises fundamental questions about the future of work and inequality. Today, I was going to focus on technological developments in finance, which are part of this broader phenomenon. And innovative technologies have great promise to do social good, but they're emerging in a world that's filled with challenges that include risks as well as benefits. And as these two forces meet, it's vital to approach innovative financial technology in a careful, coordinated, and thoughtful way. That's a way to keep the doors to progress open rather than to have them start to close. Technology holds a promise of faster, more accessible, and more efficient practices. And at the same time, we have longstanding concerns about privacy that are further complicated by the proliferation of malign state actors and others who, if they get control of tools and of centralized information, can do real harm. Contemporary issues like the ownership of information and digital fingerprints present opportunities, but also challenges. And old problems don't go away simply by shifting from bricks and mortar to digital business practices. Consumer protection and financial stability still remain ongoing concerns. In our competitive world, where nations understandably want to protect the rights and the jobs of their citizens, unresolved policy differences can easily become cover for non-tariff barriers or even backdoor taxes. Efforts to require data localization, for example, work against many of the natural advantages of a global technology platform, but they're too often the response to the threat of both jobs and information being controlled elsewhere. In this increasingly global marketplace, the challenge is to develop a clear regulatory guidance that is domestic but also international. And ideally, there'd be consistency across jurisdictions. And as important as it is, it's even harder to achieve. I'd like to begin with a reminder of the benefits that we derive from financial technologies like modern payment processing. I'll then turn to some of the risks and suggest a constructive approach to managing what I believe is an inevitable regulatory response. The many benefits are a powerful reason to get this right. To begin with, speed and efficiency in payment processing facilitates commerce and financial inclusion, and it's a catalyst for growth and shared economic opportunity. From inventory management that has made it obsolete for businesses to hold costly stockpiles of spare parts, to consumers having the commercial world at their fingertips, saving them time and travel expense, financial technology has already and is continuing to reshape the world of commerce, and we can only imagine the scope of change that will come in the future. In terms of financial inclusion, which is something I worked a great deal on when I was at Treasury, increasing the number of people who are connected to the formal financial system it is made possible by technology which lowers the cost of service and then opens the door for the unbanked in both advanced and developing economies to get a foothold on a more secure financial future. Now, when men and women who previously lived in a cash economy start to build a financial record and establish payment histories, it means that ultimately they'll have greater access to capital, both for entrepreneurial endeavors, but also for their own family security. Technology-based payment platforms can also give you a way to start building a nest egg when you don't have any before. The need to be physically present to conduct commerce is already a thing of the past. This means that in places where brick and mortar branches are simply uneconomic, there's now real opportunity to connect billions of people worldwide to the financial system. In India alone, nearly 1 billion people have been registered in a digital financial network with secure biometric identifications for each person registered. The suite of services available is just now beginning to grow, but the door is open. From Malaysia to Mexico and Nigeria, we've seen successful experiments in electronic payments and banking open a pathway to financial inclusion, and even in a developed country like our own, where millions remained unbanked, there's the possibility now of solving that very big gap. You can look at financial inclusion as a way to improve the economic condition of an individual and his or her family, and that is important, whether it's a woman in Africa seeking a few $100s to invest in a farm, or a construction worker in Alabama who needs access to capital to purchase the tools to start a home building business or to meet family medical needs. But in addition to the personal opportunity, access to capital helps to boost broader economic and job growth, especially since small and medium-sized enterprises are so often the real engines of enduring economic progress. Finally, financial inclusion makes our world safer. When we shrink the cash economy, we make it harder for malign actors, whether criminals or terrorists, to take advantage of an economy that operates in the shadows. I've long argued that the ideas of financial inclusion and combating money laundering and other malign activities cannot be seen as in conflict. They have to be seen as going hand in hand. You can't choose between the goals. And I'm proud that we made a lot of progress on that while I was at Treasury. With so many advantages, you might ask, why would anyone do anything to slow the march of progress? And this brings us back to the risks. I'll focus on 3 in particular today: cybersecurity, the concentration of risk at central points, and systemic risk that can emerge when trusted old platforms with long-established oversight are replaced by new processes that are not yet subject to appropriate safeguards. It's not that long ago that cybersecurity was relegated to tech departments, and that's certainly no longer the case. In government, it rises to the level of secretary. In the business world, it's in the C-suite. And that's where it belongs, and it's where it needs to stay. I think it's safe to say that nobody in this room has been untouched by cyber risk, whether it's a credit card stolen online or personal information hacked from a financial institution, an insurance company, a government agency. Free credit monitoring is becoming a new normal. The centralization of data in systems that make it easy for us to transact business and apply for credit or to process our medical claims opens the door to bad actors who have a powerful incentive to outsmart any protections that we build. At Treasury, I was proud that we developed a tool that made it easier and faster to access your own personal tax records when you were applying for a mortgage. And I was frustrated when we had to take it down and slow it down because imposters figured out how to use the dark web to get enough information so that they could pose as a legitimate taxpayer, file a tax return, and get the refund before the real taxpayer had ever filed their taxes. The goal of speeding up legitimate access had to be slowed down to make it safe in a world of cybercrime where secure verification practices are essential to block bad actors. When you look at the scale of hacking, whether it's government systems or credit card platforms, the possibility of causing massive exposure to harm cannot be treated lightly. It's bad enough when 1 or 100 individuals has their identity stolen. But at a larger level, the risk of corrupting trusted systems could undermine commerce and security much more broadly. And at the extreme, it presents a risk to financial stability and even national security. The answer is not to erect a stop sign to new technology. The challenge is to invest in the highest level of cybersecurity possible and to educate users on practices that they can employ to protect themselves, and to recognize that it's not a battle that you can win once and then move on, because new threats will constantly emerge. Information is key to building a strong defense. Evidence of an attack or a malicious practice can't remain in the silo where it first appears, and in fact needs to flow freely within a sector and between sectors. This means that the stigma of being attacked needs to disappear. It cannot be considered a sign of failure to report an attack, but rather a sign of good corporate or governmental citizenship to respond quickly. There can't be any suspicion that sharing information or technology to combat the threat could be an antitrust practice. And reputationally, the risk should be that the failure to disclose an attack, not the attack itself, is the risk to be avoided. We did much through both executive action and finally in terms of legislation to foster this approach. One of the very first things I did when I was secretary was to make sure that major financial institutions had somebody in-house who was cleared to get information, even if it was classified, so that we could pass along information while there was still time to react. Withholding information, whether to protect franchise reputation or worse, to permit economic rent-seeking that may come from early knowledge of an attack, should be treated as a major violation of trust. And if there's illegal activity, it should be prosecuted. The largest financial institutions have resources to build their own defenses, but smaller firms do not. And even the largest financial institutions employ many smaller contractors, and each time you do that, it can open the window to risk. This means that you need to develop best practices, you need to insist that everyone you do business with uses those standards, and you need to educate customers that they need to use sometimes inconvenient tools to protect themselves. And technology can help here as well. Unique digital identifiers and tokens that permit users to be safer don't require that you remember a number of passwords and codes that no human mind can retain at the same time. And we all know that as soon as you write it down or put it in your system, you've undermined the integrity of the system itself. The financial sector in the U.S. has made a great deal of progress, but much remains to be done, and even if the sector itself was safe, slower progress in vital connected sectors remains, whether it's the electric grid or the telecom grid. And this means that the challenge is far from resolved. Businesses must manage this exposure to risk by earning a reputation for candor and full disclosure, and when there's an incident, by responding quickly, transparently, and effectively. And sadly, we too often see that this lesson has not been learned. And each time we learn that lesson, it fosters public distrust rather than greater confidence. A second risk is that centralizing information permits both efficiency and transparency, but it also creates larger potential points of failure. And I know there are others in the room who learned this with me, but I learned this as we worked to address one of the big problems that led to the financial crisis in 2007 and 2008, which was the opaque derivatives trading system, where the inability to know the exposure of financial institutions accelerated and broadened the panicked sale of assets and deepened the damage of the crisis. The solution was to create centralized derivatives clearing platforms so that it's now knowable what stands behind traded derivatives and the level of risk within a portfolio or an institution. Centralized clearing has made our financial system safer, and therefore it's reduced the risk that a financial crisis would again bring down our economies. But at the same time, the integrities of these central platforms presented a new challenge, and we needed to develop standards to make sure that the new clearinghouses themselves could weather extreme stress and maintain liquidity and operational integrity. As new technologies and a growing number of independent payment processors carry much of global commerce, there are going to be questions about the financial soundness of those platforms and their ability to withstand the shocks that inevitably occur when there's an economic shock or when parties fail or act badly. The ability to demonstrate that large global financial platforms can maintain liquidity and operational integrity even under stress is crucial. And this leads to my third risk, that new technology needs to embrace the need for oversight to develop in an appropriate way. Long-established practices and systems are monitored through banking and security oversight, which put up guardrails to ensure safety and soundness. A new fintech application that does not take traditional deposits or trade in securities may not fit the old model. But concerns about safety and soundness are still real. What about payment cards that look more and more like they're storing savings? Or a global payment system where failure to maintain overnight liquidity could raise financial stability concerns? Emerging business models require solutions that fit the new challenges. It does not mean a one-size-fits-all approach where we use a single hammer to treat every new innovation as an old-fashioned nail. It means that we need to have an open process of inquiry that asks the questions about what risks require oversight and regulation, and what's the most effective, appropriate, and least burdensome approach. And as we're seeing this week in bipartisan legislation here in the United States to deal with advertising on social media, if important vulnerabilities are not addressed by self-governance, a government public response won't be far behind. In so many parts of the financial system, new business models do not fit old patterns. As Secretary, I urge that we ask tough questions, but only act if necessary. For example, in our review of the asset management industry. It's critical that asking tough questions not be treated as an obstacle to progress. To the contrary, it should be embraced as a way to make sure that sensible rules of the road for the future can be developed and to strengthen the ability of our oversight processes to detect real risks rather than either responding mechanically with old answers or by shutting off the radar so that we won't be able to detect the next financial crisis. So what is the right government response? Regulators should remain open to innovation, whether it's checking accounts, credit cards, ATMs, or mobile financial apps. Private innovation has and will continue to open the door to new practices that may be disruptive but also improve on what came before. But old policy concerns, from adequacy of resources to assure uninterrupted service to levels of consumer fees and interest rates, full disclosure of terms, and preventing illegal money transfers, are still going to be with us. The U.S. has traditionally been a global leader, first in developing domestic standards, and then along with other leaders, we've collaborated to establish best practices as a global norm. In the last decade, the U.S., and with my friend Paul Tucker in the room, proud to say the U.K., responded most effectively to restore financial stability in our respective home markets after the financial crisis. And we worked together through the G20 to establish the Financial Stability Board to promote global standards. I applaud the work that Mark Carney has done at the FSB and work closely with him to make sure that we leave behind a lasting legacy of a safer and sounder system, and I believe we have. We also worked in the G7 to begin a similar practice of sharing best practices and information on cybersecurity. With our uniquely decentralized U.S. regulatory system, as chairman of the Financial Stability Oversight Council, I tried to drive the work of independent regulators to address emerging issues in a consistent manner. But independent regulators are just that, and it's an ongoing challenge to minimize the development of inconsistent standards even within our own system. Work like the U.S. National Institute of Standards and Technology Cybersecurity Framework established uniform best practices. But in the end of the day, decisions on appropriate standards for bank examiners are still the purview of each individual regulator. Rising populist sentiment against globalization makes this kind of collaboration more challenging. During the financial crisis, it was essential to stop the collapse of major financial institutions to prevent a depression. But there's a lingering cynicism about deferring to elite and expert voices in institutions. There are questions about how this reliance affected pre-crisis regulatory policies. And even though taxpayers in the U.S. were paid back the capital used to stop the crisis, The lasting memory is that institutions that were too big to fail got help, while Main Street businesses largely felt that they were fending for themselves. In U.S. political debate, the FSB, for example, is too often treated as a mysterious foreign meeting of international bankers trying to impose their will on U.S. domestic policy. In fact, working through the FSB with partners like the UK, the U.S. has convinced countries around the world to adopt practices more like our own. Without harmonization, compliance will be more complicated and more costly, and may create a competitive disadvantage to firms and countries with high standards. This is one of the many examples where we need to make the case for confidence in expert bodies and to push back on the notion that elite institutions should not be trusted. In a well-informed public debate, it would not be possible to dismiss the FSB with fears of black helicopters invading foreign spaces. At the same time, ironically, some question the need to maintain the higher standards of oversight that were adopted post-crisis. For example, from the outcry that one hears about the process for designating systemically significant financial institutions for enhanced oversight, one would think that hundreds or even thousands of institutions had been named, when in fact you can count on your fingers the number of designated institutions. In reality, this authority has been used judiciously and decisions have been reversed as the facts change and as the risks change. Privacy and ownership of information, even where it resides, are important issues where reasonable approaches can vary. In the US, there's a tendency to be more comfortable when information is held by a private party, even a large business, rather than a government entity. In Europe, the opposite is the case, where there's widespread discomfort with large companies, particularly foreign companies, controlling too much information. It's important to work towards widely accepted standards because a balkanized approach is not only inefficient, it can become an obstacle to truly global systems. It's easy to see how concerns about privacy standards, consumer protections, or information accessibility for law enforcement and regulatory oversight can become an excuse for countries to demand control and even require local servers, which is antithetical to an efficient global information platform. In Europe, there's a deep distrust of U.S. technology companies over where their information is stored, who owns it, and how it should be taxed. And the use of tax and state aid authorities reflects that pressure. Harmonized standards reduce the risks of conflict and inefficiently conflicting approaches. In the long term, the environment will be more hospitable to emerging technologies if rules are clear and stable, and industry embraces the goal of getting it right, not avoiding oversight, which is not a sustainable objective. And even if it was, industry would become more vulnerable to criticism when anything goes wrong, whether or not it was preventable. In the US, we faced many of these issues over the last few years, from the emergence of virtual currencies to the expanded use of prepaid cards that are a form of both payment processing and storing wealth. We tried hard to work through approaches that would permit new technologies to flourish while applying appropriate levels of oversight of traditional concerns. In the case of virtual currencies, I was always skeptical about storing wealth in these virtual currencies, which were highly volatile in terms of their valuations. But the paramount public policy concern was how to make sure a cash-like and anonymous medium of commerce would not expand the space for illicit finance. We tried to strike a balance that permitted experimentation and oversight, and whether one is a fan of one cyber currency or another, there's no denying that the underlying blockchain technology now used by major financial institutions is an innovation that will have a lasting impact on the efficiency and integrity of our financial system, and it's important that space for innovation continue to remain open. I'd like to close with a final thought, which is that good corporate governance is key to building and maintaining confidence in new financial systems and processes. It's hard to earn confidence and it's easy to lose it. The fact that financial institutions took big risks and then needed taxpayer assistance to end the crisis left behind an environment where the challenge of building and keeping trust is even greater. Whether marketing practices at a firm like Wells Fargo or the management of a cyber attack at a firm like Equifax, it is critical to avoid even the appearance that financial businesses engage in practices that mislead consumers or withhold critical information to promote a stronger bottom line or personal profit. I'll leave to regulators and prosecutors to determine when and where enforcement actions are warranted. But industry self-governance must embrace the highest standards and treat violations of those standards as unacceptable. And there should be a cooperative approach to framing new regulatory approaches to address new business models. As we reach the 10-year anniversary of the financial crisis, it naturally slips farther back in our memories. But we know that there will be financial crises in the future, even if we can't know when they will be or what the cause will be. Our challenge is to prepare as best we can to avoid crises which we should be able to see coming, and to rebound quickly if and when a crisis occurs. At the same time, we need to encourage an environment where innovation and investment flourish. To me, this means that we should maintain reforms that have improved financial stability and confidence in our financial system. And for emerging technologies, we should aspire to clarity and stability about the rules of the road going forward. Highly political battles that suggest dramatic changes are likely each time the political pendulum swings one way or the other do not help. Financial institutions, new and old, need to know the lay of the land in order to comply and to concentrate on doing their business. And constantly changing ground rules increase their compliance burdens. The answer is not to lower our guard to real risks, but to navigate and stick to a sensible and a balanced approach. Thank you very much, and I look forward to the questions and the discussions to follow.
Thank you so much. There's so much in what you've said, but I'm going to take the liberty of the first question and then go to our audience. If I may ask a slightly rambling first question. As I look around the world today, it seems to me that China has allowed quite a lot of experimentation for a while before introducing a well-developed regulatory framework around digital currency or online lending or so forth. So they don't want to quash innovation, but it's also revealed risks that they've had to respond to. And India is going down this road as well with this, as you alluded to, the Aadhaar program has been remarkable in creating, bringing 1 billion people into the system, but India's just lost a Supreme Court case on this, on the privacy issue, and we have to see how that will take shape. And one would think that maybe the US and Europe would be the most aligned in thinking and approaches, but as you said, the privacy issues within Europe are such a source of tension within Europe. I've watched with admiration and dismay about the digital single market and how that might not unfold. So I guess I'm just sort of positing a complex question to answer, but it seems hard that countries have difficulty coming to international frameworks when their own domestic framework is still in flux. And so as you think about this relationship between the domestic and the international, one would again think that the US and Europe might be the most able to go forward, and yet our tensions are very severe in this area. So I just wonder how you think about that.
I think that is an enormous challenge. You take something like cybersecurity, where we have arguably a shared interest in keeping malign actors out. What's the right forum to share information? Well, the G20 is not the right forum because some of the malign actors are in the G20. We use the G7 as a way to try to bring countries that were more like-minded together to start, to maybe create some comfort, sharing information, sharing intelligence, sharing thoughts about what we're doing, even as we're learning how to deal with it ourselves. Why did we do that? We did that because if we waited until we each thought we had it right in our own system, it might grow to a level of risk where we couldn't come together and contain it if we didn't start working together even before we were totally comfortable that we had our own situation under control. I think that the issues related to privacy and ownership of information can kind of be divided into the things that are kind of personal liberties issues and competitive business issues. I think in Europe they're mingled. I don't think it's an accident that the very strong feelings in Europe are mostly directed at American companies doing business in Europe. I think it would actually be better if there were some European companies to frame those issues, to develop domestic responses, not to an American company having your information, but a European one. But the reality is America's leadership in this area is still quite substantial, and this will be worked through in an environment where it's the Apples and the Googles that are the straw man for any discussion about personal liberty. I don't think the fact that it's a U.S. business changes the core questions. So if you separate them, you can perhaps think about it the way you would if it was a French company that had your information, or a German company, or a British company. On that, the fact that there are different standards, I mean, it is just a fact that Americans are more distrustful of government than Europeans are, and Europeans are more distrustful of large corporations than Americans are. I don't know how you mediate that. I mean, when we did the amendments to the Patriot Act, the question of where the data that comes from surveillance should reside, the answer in the United States was in the companies. I find that personally shocking because I trust government protection of that information more than a phone company's protection of that information. I suspect the answer to that question in Europe would have been the exact opposite. Now, I don't know that you can harmonize it completely. It may be that you have to just be open enough about talking about it that you can have different approaches that can coexist, and mutual recognition of protection standards that you can be comfortable with. If you don't talk it through and work it through early, the pace of technological change isn't going to slow down. It's going to keep speeding up. And the amount of data that is out there will grow exponentially, and it will make it harder, not easier. So I think dealing with this issue sooner rather than later is going to be really important, both in our domestic context and internationally. I wish that there was a simple solution. I don't think there is.
Mm-hmm. Thank you very much. Let me invite Jindong Hua to speak. Of course, I'm going to give you a little advertisement, Jindong, because he comes from the IFC, which has really been doing some innovative financing structures to deal with long-term problems that need private sector responses, and I know you've been architecting some of that.
Thank you, Dean General. Secretary Liu, first of all, thank you so much for your strong support on the financial inclusion agenda, because this is so important for global consensus on fighting poverty. There were some adverse effects of strengthened regulation on correspondence banking remittance. And the effect on developing country has been very, very severe. Give you a couple of numbers. For example, in Nepal and Liberia, remittance is about over 30% of GDP. And yet, the cost of remittance stays about 7%, both because of the AML KYC issue, and also because the international clearance system is not unified. Meanwhile, correspondence banking, which underpins international trade, a lot of OECD banks simply don't want to touch it anymore. So one number I can cite is in Liberia, 10 global banks essentially closed half of the corresponding relationship with local banks, which really means that if you want to do trade with the Liberia private sector, you run out of option. Yeah? So, but I do recognize that the regulatory tightening to fight global terrorism, anti-money laundering, these are very legitimate things. So I think now we have a solution in technology. That is, how do we find the balance between the need to ensure security, international monetary flow do not undermine international peace and security. On the other hand, how do we take advantage of AI and technology so that we can encourage, a much faster identification of problems. Because otherwise, trade impediment here is really stymies entrepreneurship and financial inclusion. Thank you.
I think you're asking a question that is of extraordinary importance, and I spent an enormous amount of time working on this issue because it presented itself over and over again. There was a moment while I was secretary where there was a real possibility that there would be no corresponding banking relationship between the U.S. and Mexico. Now, that would have been a big deal. It would not have been a good thing for the U.S. economy or U.S. security or for money laundering. With Mexico, we could engage and did engage effectively with both the finance ministry and the central bank for them to improve the quality of their system so that it could meet the standards to keep enough American correspondent banking relationships that you don't hear discussion of that risk anymore. Let me go to the other extreme, Somalia. It is a case where we desperately want Somali expatriates to be able to send remittances to their legitimate family members who are suffering. There's no infrastructure in Somalia. There's virtually no banking system. There's no identification system. And there's no ability to know whether you're funneling money into Shabab or into your family's bank account. Now, those are very different cases. I think we approached it, and I can't say I know what the current administration is doing, but I know what we did. First of all, to try and bring the U.S. regulators who set the standards together to try and be clear about describing what the goal is. So the goal was not to shut down correspondent banking relationships. The goal was to not have illicit transactions. One of the things that was most important was to get the enforcement agencies to agree to put in writing what their strategies in enforcement are. Because one of the reasons that these correspondent banking relationships were challenged was the fear that a foot fault could lead to some very large financial exposure. Now, in reality, no foot fault has ever led to a mega penalty. We looked back over virtually all history, and no foot fault has led to the horrors of billion-dollar settlements. The billion-dollar settlements were always for repeated acts of intentional fraud or criminal activity or terrorist financing. Now, to get regulators to say that took me almost a year. Prosecutors do not like to say that we don't prosecute innocent errors. But in fact, they don't. We did get them to say that. We put out a statement, and I think it actually eased the environment considerably. There are a number of other things we did. But the other piece is technical assistance. And the IMF and the World Bank and the UK and we are the leaders in doing this to help in places. Somalia may be the extreme, but in the Caribbean, there's a half a dozen countries that just need to strengthen their systems. In Africa, there's a dozen or more countries that need to strengthen their systems. That takes having knowledgeable people come in and help teach you how to do that. And I agree with you, technology could help solve the problem. In India right now, there's not a risk of not being able to identify who you're doing business with. Our policy was never that you need to know your customer's customer. You needed to know your customer. Well, in India, you can now positively know your customer. If Somalia had that ability, they'd be on their way to solving the problem. I don't think there's an easy solution. I entirely agree that, and that's why I said in my remarks that you can't have it be a choice between financial inclusion and protecting against money laundering. They go together. And I don't think we totally solved the problem, but I think that we made more progress in the last 18 months that I was there than, frankly, I've seen on a complex problem of that nature in other cases.
Thank you very much. Sir, could you introduce yourself, please?
Yeah, my name is Michael Bordo. I'm a professor at Rutgers University. My question pertains to something you said at the end of your remarks about virtual currencies. And so I was going to ask you if you could say a bit more about the possibility of what are called central bank digital currencies. So in a lot of countries, around the world, they're seriously studying introducing something that they call a central bank digital currency. And the reason they're thinking about this is because they see the problem of these cryptocurrencies as creating some instability in the payment system. In economic history, we saw that in the 19th century. We had, free banks or banks that issued different kinds of money, and they were convertible into gold at different exchange rates, and we had an impaired financial system. So that led to, in each country, the creation of a central bank that, that had, in a sense, had a monopoly on the currency. So the same issues are coming up again, and I just wondered if you had any ideas about that.
I'm not familiar with the idea of a central bank cryptocurrency. I think some of the issues are really the issues that we deal with cash. There's a reason that there's debate now about what should be the largest denomination bill. I personally believe a $100 bill still makes sense, but some of my friends disagree with that, and say we don't really need more than a $50 bill because the suitcase you need to move $1 million is much smaller if you have $100 bills than $50 bills. Europe still has a 500 euro note. I worry if cryptocurrencies are as anonymous in a central bank context as they are in a private platform, that the ability to control large invisible transactions would be really challenging. Now, maybe if it's held by a central bank, it won't be as anonymous and it would just have all the efficiency benefits without the anonymity. For some reason, I don't fully understand. People who are doing nothing wrong like the anonymity feature. I think it kind of gets to this distrust of government. Why do you need to know what I'm doing? But that's what I think presents the real challenge in a public policy context. I haven't thought about the financial stability risks in a serious way because, frankly, they're not big enough to have. That wasn't the pressing issue of the day. But I think China is now dealing with it in its kind of infancy. When as the dean said, they were very open to experimentation in Bitcoin until it became the major means of taking currency out of the country, and it started to undermine the policy and the economy that they were building. And now they're clamping down on it. I think we're all trying to learn how to deal with cryptocurrencies. I know my staff would never let me use the tulip analogy, even though I wanted to. And I don't know why Jamie Dimon could do it and I couldn't do it. But, that's not a good enough reason to stand in the way of it. People are free to store their value in tulips or bitcoins. I wouldn't do it. But the concern about illicit finance, that is a real public policy concern. And if it became an issue of financial stability, that would rise to a public policy concern as well.
Thank you. Let me collect just two more questions. Sir, in the back, yeah. And
Thank you, Mr. Secretary. My name is Wilson Irvin from Credit Suisse. Your old department has been reviewing the financial landscape in a series of reports that I guess they're about halfway through now, trying to reflect on where regulation in the Dodd-Frank era went, where it might have gone too far, and where there might still be more to do. It's been a lot less extreme than you might have heard from campaign rhetoric, but they still propose some changes. I'd be curious as to your reflections on either those reports or the state of financial regulation today, where you think changes are warranted and where you think you'd like to retain certain features of the system.
So I've read the reports, and I must say I was surprised that the tone was more moderate than one would have expected from the political rhetoric, but I'm not sure that we know in the end what they're going to be recommending. In almost every area, they didn't say what they would want to do. So that moderate tone could be reflected in moderate policies or could be reflected in proposals that I would think were quite extreme. So I don't think we really know. I was on an airplane last week and read the latest report, which was really long. It was like 150 pages. It didn't have any specific details about what they would do. What I think is notably not in those reports is a retreat from the idea that better capitalized banks are safer. I didn't see any indication that there is a desire to roll back on capital requirements in a meaningful way. And if anything, I think that there is a view that more capital makes it unnecessary to do some of the other things. It's belts and suspenders. So I think, jury's out. We'll see where they go. It is strikingly different from the tone of the way Congress has dealt with the same issue, which is totally irresponsible legislation that would take away everything we've fought to build in terms of a safer system. I don't know that that's where this goes. I'm sure there will be recommendations coming out of it that I disagree with. So I don't in any way mean to be endorsing it. But it was striking to me, A, for the fact that I don't know where they're going, and B, for the fact that it doesn't appear that they're rolling back on capital. Let me tell you something that I am very worried about, and in a budget context, this is a real risk. One of the features of Dodd-Frank was putting in place Title II, Orderly Liquidation Authority. Orderly Liquidation Authority is one of the only tools that a Treasury Secretary, a Fed chair, and an FDIC chair have in a financial crisis. Essentially, it is a tool where if there's a financial crisis, 3 keys have to be thrown, but you have the ability to provide the equivalent of DIP financing to prevent the unwinding of an institution. For a crazy reason having to do with arcane budget scoring rules, our Congressional Budget Office treats it as saving on the order of $20 billion to repeal that. The arcane reason is that in the first 10 years, they assume that some institution will fail, and the repayment won't come until the next 10 years. If you look over a 20-year period, it's a wash. In a budget environment where saving money in the first 10 years is a challenge that I can tell you as somebody who kept offset lists for a lot of years, anything that saves you $20 billion in the first 10 years is on everybody's list. And whether they do it or not depends on the judgment applied. I'm very worried that that is going to go through Congress. And if it does, I don't think the administration supports it. I don't know that they would stand in the way of it. And if that tool were removed, I can tell you that we did these roundtables, these tabletop exercises, first with our friends in the UK and then with the Europeans as well. It was all we had in a crisis. The 2 things we had were the TLAC that was kind of put in place because of the work we did with the FSB and Orderly Liquidation Authority. Other than that, we were like out of luck. And I think the idea of repealing it is terrifying.
Thank you. Last question or comment. Sir?
This David Weisford on the OFR Advisory Committee. So we've talked in this conference about populism and the impact on the financial system. And I wondered if you have an insight as to the gray area, the line of demarcation between populism and demagoguery. And by this I mean, while it's understandable that people, Mrs. Watanabe, are upset about the bailout of the banks because Main Street wasn't bailed out, but as you point out, the taxpayer was repaid with interest and so forth. And in the wake of that, there were substantial reforms in the form of Dodd-Frank. And I personally have no doubt that history will shine very well on you and on your predecessor and on the Fed chairman and the work they did to preserve the system and to diminish the very major consequential damages that would have occurred had they not acted in the way they did. And so it leads to this question as to, it's a fine line, maybe not a fine line, between populism and the view of people out there about the bailout and out-and-out exploitation of that populism.
So not to make it a hobby horse, let me continue with what I was saying about Orderly Liquidation Authority, because I think it is an answer to your question. I mentioned the fact that it is an almost irresistible target because it has a $20 billion offset attached to it. It also gives populists of the right and the left the ability to inaccurately say they ended too big to fail. And that makes it a real risk that if something appears to solve a problem that's driving public anger, action could be taken. That's demagoguery. I mean, if you take away the tools to deal with a crisis, and you do it in the name of saying we're never going to bail out a big bank, you're creating a straw man. You're knocking that straw man down, and you're leaving yourself defenseless if you have a crisis. I don't know the difference between populism and demagoguery in a purely political rhetorical context. I fear populism on the right and the left because it hasn't led to good outcomes on the right or the left in other countries. We've usually in the United States had a fairly high level of skepticism about populism. Soaking the rich has never been a way to maintain broad support because this is a country where everybody hopes that if they work hard and play by the rules, they'll be able to make it. One of the things I worry about in the current environment is with the growing inequality, that the social contract, which has led to that rejection of populism, is getting thin. That social fabric depends on the proposition being real that everybody can make it. If it becomes just accepted as reality, that it's not on the level, that it's rigged in favor of those that already have wealth and high incomes, I don't know that you won't see a change in the openness of the U.S. I mean, I personally view this last election as not necessarily the final bellwether. It was the expression of anxiety and anger and rejection of the status quo. But ironically, the policies that we're seeing put in place will only increase the things that are driving that anxiety and that anger. I worry about how the public responds when they've rejected the two conventional parties, and then somebody outside of the system comes in saying, I'm different, and it makes it worse. Now, do they come home to one of the old homes? Is there a new centrist party that emerges in one of the old homes or in a new place? I don't know. But caring as deeply as I do about liberal democracy and free market capitalism, figuring that out is highly consequential to the next 100 years of our history.
Thank you very much. Please join me in thanking John.